Let's kick it off with gold today here, David. It's new all-time high territory, but as you can see on the chart here, pretty much on these daily candlesticks, we've pretty much made an all-time high every single day. So what phase in the gold bull market, and we'll get to silver in a second as well, but what phase in the precious metals bull market do you see us in right now?
Yeah, let's be a bit of a long-winded answer. I'll try to make it succinct. I mean, anyone that's listened to me over the last, few years or the decades I've been on the web, I've talked about 90% of the move comes the last 10% of the time. Those are not exact numbers, but the idea is correct. We get the final phase of any market, especially the metals, is the acceleration phase, where you get the biggest capital appreciation in the shortest amount of time. To prove that point. And does it work every time? Yes and no. I mean, it works to the idea that you get an acceleration. So in 1979, January, silver was $6. A year later, January 1980, it was $50 intraday. And so it made 850% gain in a matter of like 11 months. So it was like the exact math on that, I forget, was like 87% of the move and 7.5% of the time. So the idea is we're there. We're in that part. Now, the answer to further the answer is, well, how high is high? And as I like to say about how to really trade stocks or futures is, buy a new high. Because if a stock goes from 5 to 50, how many new highs does it make? A lot of them. We don't know. It depends on the stock. You can see once it peaks, you can count them. But, a new high, new high, new high, new high. Oh, my goodness. And once you get into this mode, I mean, it's absolutely stupid to trade to the short side. You must trade from the long side the whole way up until it peaks. And that's why, now if you're hedging, that's different. Hedging is not speculating. If you've got it locked in, you think, I'm happy at, $110 silver, and that's where I want to hedge half my portfolio because I don't want it coming back to 50. Well, that's a different modality than saying, oh, I'm short in silver, it can't go over 100. So anyway, two things. We're in an acceleration phase, and we are need to trade from the long side only. Last thing is I did this run to gold analogy. Danny, you've probably heard it. I'll try to, again, be brief. But I said, the run to gold has begun, and I said that back when gold was around the 2000 level, when the banks started buying gold hand over fist. I said, look, bankers are in. They're buying at a greater rate than they ever have in the past. And the run has started. But the run starts with the, kind of dragging your feet walk, and then a normal walk, a brisk walk, a light jog, a full jog, a fast jog, a light run, a full run, and an all-out sprint. And so one of my members asked me like 2 days ago, and she said, are we at the all-out sprint? Because in a way, if you look back a year ago, I mean, look at the acceleration we've seen, and you could make the analogy. I don't think we're at the all-out sprint, but we're past the light jog, past the jog, into maybe the fast jog, the way I see it. We've yet to go into the light run, the full run, and then the sprint. And those are when the public comes back into the market. So right now we've seen many, many silver investors that have bought silver for years dump. They are just selling their silver, and they can't, they're happy to take, $10 under spot for it or whatever the market's bearing right now. So until that clears, and there's an emphasis for new buyers to come in, thinking or feeling that silver's still a bargain when the gold silver ratio is 50 to 1, when it could be 30 to 1 or 15 to 1. And I think that will happen. And it's really a bifurcated market from east to west, not only in the arbitrage, but in the attitude toward purchase. The West, North America, is primarily sellers, whereas the East, Asia, primarily is still buyers from the retail side.
Late-stage bull markets compress time. Most of the total price appreciation tends to occur in a surprisingly short window, driven by urgency rather than optimism. Historical examples in precious metals show this clearly, particularly in silver, where explosive moves have unfolded in under a year. This doesn't mean prices rise in a straight line, but corrections become shallow and brief. In this phase, betting against the trend becomes increasingly risky. The dominant strategy shifts from prediction to participation, as markets reward those aligned with momentum rather than those waiting for perfect entry points.
I mean, I have to be aligned with my premise. And the premise is the final phase is the greatest capital appreciation, and it accelerates. It happens in a short amount of time. And let's just use that, excuse me, let's use that as perhaps a year and a half from now. And that's a wag. It's a wild guess, but it's not 10 years from now. I don't believe that. Others do, and you can. And I'm not saying I'm right. The market will tell. So going back to your question, that peak at 2011 was a 33 to 1 ratio. And we're around 50 right now. So if I'm right, we're in the final phase, it's got to do better than that. So that means it's got to go, maybe half again is what it is now. Let's say if it goes half again, it'd be 25 to 1. Which is better than a 30. So in that case, you would be doubling your money relative to your gold position if it was all silver. So yes, I do believe that's a signpost. I do believe it's a marker. And I do believe that we're going to do better than the 30-to-1 ratio we experienced in 2011.
Yeah, as I'm looking at this chart, it looks like you've got a double bottom here and a double bottom here and one here and one here. And from a macro standpoint, one here and this entire thing here. So could this be something that could be unprecedented in the silver to gold ratio standpoint?
I wrote an article, one of the first I put on the web, quarter of a century ago, called Engineering the Price of Gold. And I explained how you determine the paper price of gold. And going through that arithmetic, I said, okay, well, what about silver? Silver is really not a monetary metal. But how do we determine? And so I started using the gold-silver ratio as a means to determine. And what I call the classic or monetary ratio is 16 to 1, 15 to 1. And on that basis, I said, and at the time, the theoretical price of gold was 2,500, and we were at like 250 or something. So it had like a 10 bagger to go in theory. And so then if you take, and I said it could go to 10 to 1 in an overshoot. So 10 to 1 would be $250 gold silver, $250 silver back then. So I don't rule it out. And on an overshoot, we might go past the classic or monetary ratio of 16 to 1. And if that were true, then it's got to be less. It'd be 15, 14, 13, 12, say 10. 10's easier to do in your head. So if you got $5,000 gold and you do a gold silver ratio of 10, you're looking at $500 silver. Now, do I really, really think it's going to get there? And the answer is I do not. But I certainly think it's getting above 30. So where does it land? 25, 20, 15? Does it go to 10? I don't know. Could. I certainly wouldn't rule it out. If it did that, I believe it'd be a spike like it shows on your chart here. And you'd want to be sitting at your computer when it hit that, swap out for gold or sell out or whatever, but it's possible, certainly.
The gold to silver ratio remains a key indicator of where the cycle may be headed. While gold typically leads during periods of uncertainty, silver often outperforms once confidence in the trend solidifies. Historically, major precious metal peaks have coincided with sharply lower ratios than today's levels. A narrowing ratio would imply silver gaining ground at a faster pace than gold. Whether that adjustment stops at moderate levels or overshoots remains uncertain. What matters is the direction. A shift toward silver strength would confirm that the market has entered a more speculative late cycle phase.
And that's kind of the specialty that we, have here at the Morning Report. Looking at the equity side, we're still undervalued across the board. I mean, some of the bluest of the blue chips are still undervalued relative to the price of gold and silver right now. So they're pretty good buys. And I think everyone that follows your work now knows that, Rick Rule sold, a good portion of his silver and is buying, silver miners. And a PE is not a very good measure of gold company. It's free cash flow. But at the top of the market, it's actually a pretty good marker. And at the top of the market, a good silver company will sell for about 50 times earnings, where a good gold company will sell for about 30 times earnings. So right now, we are undervalued across the board. I mean, there might be some juniors that are overpriced or something, but as far as the the blue chips and the mid tiers and even the junior producers, all the ones that I follow are undervalued right now. So if you're late to the party, you might consider doing stocks. I always advocate the real metal first. But if you're going to add to your position, you could do a Rick rule. You could sell your metal for stocks or part of your metal for stocks, which is what he did. You could, there's lots of ways to do it. But, and that doesn't mean that if you buy today, you're guaranteed the stock price is going to go up. We could get a correction any day. In a bull market, we usually get some pretty scary corrections on the way up. Enough to where, some of the Twitter guys will come back on you and me and get in our feed and say, see, Danny, you and David are wrong. Silver's back down to $80. It's under 100. Hasn't touched 100 in 6 weeks. See, you guys are wrong. And then, 3 days later, it goes limit up. It's 120. I don't think this bull market's over, as I keep stating. We haven't got the panic manic phase. And the fundamentals are so strong that, the reason gold is there is because it's the money it's the ultimate money. It's the money of last resort, and the banks are still buying hand over fist because if this whole system collapses, which it won't, but if it's trending that way, and it is, because the treasury market is a mess, no one really wants to buy long-dated assets based on their credit. The credit of the United States, the credit score of the U.S. is going downhill rapidly. Not so much by Moody's and other rating agencies, but by the marketplace itself that says, I don't want to buy your treasury bills, bonds, or notes. I don't want it. And so the Fed has to buy it and make up for it, which is going to push interest rates up, Mr. Trump, regardless of how much you want the Federal Reserve to lower the discount window or federal funds rate. It's not going to work. So anyway, I'm on a high horse here. I'll get it back to you, Danny.
One of the most striking features of the current market is the regional divide. In Western markets, longtime silver holders are taking profits, relieved to exit positions held for years. In contrast, buyers across Asia continue to accumulate, viewing precious metals as long-term savings rather than trades. This imbalance has prevented meaningful price resets as selling pressure is absorbed quickly. Until Western investors return as aggressive buyers rather than cautious sellers, the market may not yet have reached its most emotional phase, the kind typically seen near major cycle peaks.
We're in a bifurcation where we're going from things on credit to needs. The commodity sector are needs. You need cotton, you need oil, you need soybean oil, you need soybeans, corn, wheat, cotton, you need all of that. You need the metals. And because of that fact, everything that's on credit, which is, your car loans, your mortgages, your commercial real estate, all those things are in jeopardy. But everything that's a tangible, real wealth is gaining in value because it's the most valuable. You've got to have oil or you don't have any energy. So those things, the commodity sector is going to be king of the hill eventually. In other words, the stock markets worldwide are generally going to trend down and the commodity sector generally is going to trend up. And they're going to crisscross. If you plot the S&P versus one of the Commodity Research Bureau's indices, and you're going to see those indices cross where the commodities are going up and to the right and the stock markets are going down and to the left.
Despite rising metal prices, many gold and silver mining equities remain undervalued relative to historical norms. Cash flows have improved, balance sheets are stronger, and yet valuations have not fully adjusted. In past cycles, mining stocks tended to peak later than the metals themselves, often trading at significantly higher multiples near market tops. Today's discount suggests the equity side of the sector has not entered a euphoric phase. For investors already holding physical metal, selective rotation into quality producers may offer leverage, though volatility should be expected as the cycle matures.
Yeah, that sounds absurd, but it's not. And first of all, we're looking at it. So we have history that we can just say, well, wait a minute, that's the fact that we're looking at. And then to say, well, it's going to go up eightfold, and it could. It could go above that. Now, I'm not predicting that it's going to go above that. But what I am predicting, and you can get there two ways. It isn't like oil's got to go up eightfold. The stock market gets cut in half. That's a whole different delta between the ratios. And I think the stock market could fall by half. Not many, well, some agree with me, some don't. The only reason I hesitate a little bit, Danny, is, in a true hyperinflation, the stock market will just keep going up and up and up, but it will not maintain the purchasing power that gold and silver will.
At its core, this bull market reflects a deeper shift away from credit-based assets and toward tangible value. Governments are issuing more debt into markets, showing less willingness to absorb it. Central banks have responded by accumulating hard assets, particularly gold. Meanwhile, commodities represent necessities: energy, food, and materials, not financial promises. History shows that during periods of monetary stress, real assets tend to outperform paper claims. If this pattern continues, commodities may rise even as traditional equity markets struggle, marking a decisive reordering of global capital priorities.